Well, hello. Welcome back, everybody, to this live stream today on the 25th of March. What a beautiful day for markets to be opening. We have pretty much hit some important targets that I had set forth on the previous live stream. I hope that you caught that one. If you haven't, you can please look at the videos in my watch list, and you should be able to find it pretty easily. So on the previous live stream, we went through some macroeconomic conditions, the environment within corporate bonds, and also just the general idea that corporate America is under severe distress. And we went through also my view on the top-down approach of the U.S. economy, where GDP growth is going, where unemployment is going, and just the overall climate in which this coronavirus is basically destroying our economy in terms of efficiencies. So today, I kind of want to take the time to discuss some important things. Let's first get into the analysis of the market, after which I want to go through a couple of concepts relating to position sizing. And I hope that this kind of helps you guys so that you can basically get a lowdown here. Okay, let's see. So Monday, we went through the analysis and the conclusion was that we would see SPY have a relief rally, which would be a dead cat bounce version 2 after dead cat bounce version 1. And we anticipated it to go to 3 different points. So the first was the 23.6 fib retracement. The second was the 38.2 retracement, and the third was the 50 retracement. And as of today, this morning, we actually hit the 23.6 retracement, which is actually nice. This chart is not updated because TradingView doesn't update live, but you can see what happened here. We actually went up all the way to 2,500 on SPX, which is about 250 on SPY. So we basically hit the first target. And I see us possibly even going up to the 260 level. However, there is a little bit of fear in the market right now. And the reason why the fear is coming back in is because no one knows what the unemployment numbers are going to look like tomorrow. There are some crazy projections, and we know that a lot of people are going to get laid off during this time. So there's going to be a lot of uncertainty during this time for the unemployment numbers. And yeah, I just wanted to say hello to all of you guys. Welcome in. By the way, if you don't know, this stream is partnered with Option Swing, which is a community which has almost 800 traders that we meet and we discuss market positions every day. Shout out to Option Swing, Jason and Jose who run it. They're awesome people who really know how to run a proper channel. I have been a part of various other channels and they're just not as good. So I hope that you guys continue the good work, and I'm proud to be a part of the team there. If you want to check out Option Swing's website, it's optionswing.com. And I can tell you that people who join have never regretted joining their community. So I highly recommend. If you're a trader who's just starting off, we concentrate a lot on education, and that's the reason why this stream is such a big part of the channel as well. We want to concentrate on education first and profit second. So that's our motto. All right. So moving back to the analysis, right? We have SPY hitting this 23.6 level, and then I see it going up to the 260, 263 level to touch this next fib. However, as I said, nothing ever goes up in a straight line. So don't expect SPY to go like vroom up like that. No, it's not going to be like that. There's always going to be an up and a down and an up and a down and up and then go up to touch that level. So we did actually have a pretty big increase to go touch 250 today, which was this big rally up here. And you can see on this chart as well, we went up to touch exactly the 23.6 and came back down. So I expect us to go a little bit down and then the next day, go back up, try to break this again. So if you were holding puts, yesterday, I don't think you should be sweating yet, because you might actually get an opportunity to get out of those puts. As you know, these candles have been huge. These have been big, volatile periods. This is literally a trader's paradise, guys. Every single one of these candles are fluctuating, on the basis of like almost like, let's see, from 224, like 200 points on SPX, right? Which is crazy. That's like $20 or $25 on the regular SPY ticker, right? It's going up and down on that basis per day. So you shouldn't be scared if you got into puts and you're like, oh my God, I'm dead. No, you have time to get out. Don't worry about it. But make sure that when you see the next sell-off, don't be greedy. And don't be, if you have a short expiry put position, don't be greedy and hang on to those. Unless you have a long expiry put position, something like April or May, then you should be, okay with that. But right now, if you're holding a short-term put position and it's, maybe expiring on Friday, or it's expiring next week on, Tuesday or Wednesday, I would take caution, and I would, try to exit those on the next downtrend. As we start to kind of reverse and test these new fib levels. So that's kind of like a little start off. I want to cover those bases right now because, I want to get this out of the way. And today we were actually going to talk about important concepts on position sizing, which I'm going to go through right now. So here are some things that I want to go through with you guys. So there are some basic common mistakes that traders make, and I want to highlight this to you guys. And I'm going to go through this pretty simply because I see a lot of people lose their entire portfolios with really bad portfolio management skills, or rather they take trades based on emotions rather than probability and statistics, and it just destroys them. So here's like some basic stuff, okay? Now, if you are this stock trader, the one who takes, let's say you bought stock A at $10 and you set a stop loss at $9, and that distance between the stop loss and the price of the stock was $1. And then you took your profit at $11 and the distance between your price of the stock and the take profit is $1. This is not a very good setup for you to keep winning. Now, the reason why this is so is because your total risk to reward ratio is always going to be 1:1, which means to say every time you lose $1, you gain $1. And if you continue with this system, there is no edge. You're not providing your portfolio a edge in terms of probability and statistics. So this, and by the way, the inverse is true for short selling. So if your take profit is on this side and stop loss is on this side, it's exactly the same thing. It makes no difference. But if you keep this kind of a system and you always say, okay, so for example, let's look at it on the chart basis, right? And then hopefully on the chart basis, it makes a bit more sense. So let's just look at SPY on the 5-minute chart and try to make sense of what I'm saying, right? Okay, so let's say that you took an entry into your SPY position here, right? 234, and then you aimed to exit, or rather you set a stop loss of maybe 2%, right? Which is about $4. So your stop loss is at 229, which is here, right? Somewhere. 229 is here. Okay, so let's draw a line there. So let's say your stop loss is somewhere here, okay? And this is the distance between your initiation of the position and your stop loss, okay? You took a risk of 2%. I'm just giving rough numbers. I'm not going to go accurate into exactly, oh no, it's actually 228.65. No, I'm just telling you the rough numbers because I want to make it easy. Okay, now if your risk is $4, and your return is also $4, which means your return would be 238, right? Which is going to be here. Let's just say here, okay? A little higher because it's not equal. Okay, that gives you a 1:1 risk to return ratio. Now, every time you lose this much, you're going to gain that much, right? But if you increase your return to 2 times your risk, you would realize that over a large number of trades, you will always come out ahead, even if you didn't hit your stop loss, if you didn't hit your take profit. Because every time you lose, you would lose 1, but every time you gain 2. So that comes to the systematic approach, right? Where losing streaks can definitely occur, and you have to be aware of this, okay? And risk management helps you to maintain a systematic approach to trading, and it builds discipline, because what this is discipline. I don't know if many people of you know, but trading is 90% patience, and I absolutely I live by that. Like I try not to take too many positions, because the less positions you take with higher accuracy, the better. Of course, this is without taking into account scalp positions, which are a completely different ballgame, right? But if you always take a fixed percentage of your capital as a risk and expect double returns, which is this scenario here, where your price of the stock is here, you have a distance of X, right? And your take profit is always 2 times of X. This would always deliver your portfolio gains in the long run. If you always follow the system, you will always come out ahead, because every time you risk something, you lose $1. Unless you go 10 times, right? And you risked 1% 10 times, you would lose 10% of your portfolio. If you risked 3% 10 times, that's 30% of your portfolio. And if you risked 5% 10 times, that's 50%. You only lost half. Now, if you tell me that in 10 times, you lost all 10 times because of sheer bad luck, you know what? I can get on board with that. But there is no way you would go 20 times by losing all 20 times. If you did that, then something's wrong with your system trade, like the way that you're trading. And you have to realize that whenever you lose, it hurts. It's a psychological pain. It's not something that you can control. So keeping your risk, well defined, it improves the odds of the favor over the number of trades that you take. Okay. And I wanted to really mention this to you guys because it's important, okay? And one more thing, just, kind of to go over the behavioral finance of things sometimes, okay? When traders win, as I have highlighted here, they tend to focus on the growth, and they're like, oh my God, I made 40% today, okay? And when this happens, it creates like a pretense that you are overconfident. Like it makes you overconfident for a short while. It's just a bias that your brain kind of registers, and you have to be aware of this. These are pitfalls over trading strategies that you have to be aware, okay? And if you don't properly manage your risk, what's going to happen is you're going to end up increasing the size of your bets when you win. For example, you start off with 5K and you made 5K in one day. You'd be like, holy crap, I just made 100% of my portfolio today. And then what you're going to do is you're going to bet all your 10K on the next trade. And that's going to just increase your risk and your lever. And in the long run, if you just continue with that trend, one day you're going to lose everything. So the overconfidence that winning sets you up for is dangerous, and I want to highlight this. And another important thing are these right here, right? You want to focus on facts, not the stories on the news. Focus on the macroeconomic facts. What are consumers doing? What is inflation doing? How is the liquidity in the system looking? How are banks handling their risk? What is the credit risk scenario, right? Those are things you should focus on right now. And you have to always tell yourself that you know less than you think you do, because there are always people out there that know more and are going to have an edge over you. So you have to always think that there's a lot more to learn, okay? And not many people know this, but statistics play a huge role in trading. Like, you have to consider the odds of the coronavirus affecting the market. We did not know that this would be a black swan event. And a black swan event is an event that is out of the probability curve, right? We have a probability curve that looks like that, and this is not even in that curve. It's a black swan event. It's a fat tail which the statistics can't even take into account, okay? And you have to know that statistics play a big role in this, in trading itself. And the next thing is, make sure that you sell your losers quickly and ride your winners longer, in this environment at least, because you have lots of volatility to play with, and this is going to benefit you in this environment, okay? And don't value something more just because you own it. I've seen this happen time and time again in our chat, and I'm not saying that some of you, do it very often, but all I'm saying is be aware of it. When you have set yourself up with a bias of your own mental trade, like something, for example, I took a long in Apple today. All of a sudden, I'm talking about how great Apple is as a company. And you shouldn't overly value something just because you own it. It's not a very good approach to trading. It's going to set you up for loads of disappointment, and I really hope that you would not do that, because it's going to set you up for disappointment. Okay, let's see if we can get in a couple of live stream questions here. So, what if I have a put till next Friday? Good morning, by the way. Good morning to everybody here. Thank you for streaming, tuning in. I hope that you find this useful. Well, if you have a put till next Friday, I think you should be good, man. You can hold on to it, but I would recommend definitely watch what's happening to the market by let's say Thursday, tomorrow, and then on Friday, if the market has gone up too much, you could lighten your position, or you could choose what you would want to do from there. Are there any more questions today? Or is this going to be a very short live stream? Let's see. I'm going to wait out for about 5 minutes here, see if we can get any more questions here. Do you expect to pull back to 220 before SPY test the next fib, or did I misunderstand what you said? I have SPY puts until Monday. Okay. So here's what I said. Just to clarify again my position and what I see happening, okay? Okay. You have to first realize that every single day on this chart is hugely volatile, okay? Which means to say every day we are moving between $15 to $20 in price action, okay? And so if you are holding puts and we hit this 23.6 fib level, and then we kind of came down from it, which is what you see here. Like, you won't see on the other chart because this one's updating live, the other one isn't. But you can see we hit the 23.6 and we came back down, right? Right here. And since this came back down, there's a chance that we see it coming down somewhere, $20 from up here, right? Let's say 250, maybe 230, right? So we can see SPY come down to 230, or maybe even 235, something like that, right? This is the distance at which I see SPY retracing back down today. So if you're holding puts for next week or Monday, you're gonna have a chance to get out of those. All I'm saying is, go by what your position size is and go by what your position is, but try to be careful of the fact that SPY is going to ultimately make a run to hit the 38.2 fib, because it has to go up to complete this dead cat bounce. Now, after it does that, you should start to load up on puts up here. So if you have puts now, the right strategy is to hold them and get a better exit as we go down in this volatile day. That is what I said. Now, let's see what else. Disney. How far can it go? Disney. I haven't looked at Disney. Good question. Let's see. So at this point, I believe Disney is kind of following SPY. But you have to ask yourself one important thing. Do you see Disney's parks and hotels being opened up anytime soon? Their business does rely a lot on that, branding and advertising and selling merchandise. Right now, there's, during times like this, entertainment is put on the back burner. People are rushing more towards consumer goods and, consumer discretionary goods, I would say, right? So you have to ask yourself, is Disney going to really rebound quickly here? The answer is, I see at least a 50% retracement on my opinion. If we take it from the swing high to the swing low, the 50% is going to be at around 115. But I don't see it going up like right away. As I said, it has to break through these fib levels, right? And then you may see it. I think it's moving along with the market. So try to time your Disney position along with the market. For today, for example, we saw SPY go up all the way to the 2,500, so 250 level, and then it came back down, and now it's consolidating in this range here, right? So you want to make sure that you try to time your Disney position with SPY. Let's see, I agree. Thoughts on Disney? Good morning, Oscar. Yesterday, SPY started to climb, and the puts did not lose value. Yes, I saw this exact same thing happen. So let me try to explain. This is a really good question, and this is the reason why I love, these questions that come in. A really, really great question. Okay, so why is it such that yesterday SPY rallied and your options either stayed the same value or gained the same value? Now, let me explain to you guys a very, very important concept about options. When you buy an option, you're not ultimately betting on entirely the stock price move, even though it is a derivative instrument, which means to say that the stock price moves the options contract. You are ultimately betting on what people think about the contract. So it's kind of like a inception kind of a thing. You're betting on the contract, and the traders think one way about the contract. So yesterday on this rally, people didn't really think that this rally would last, and they were right? People started actually buying puts yesterday on this rally. That's the reason why your contracts were not going down in value, were losing very little value, and at the same time were being bought up. For example, I myself, I'm holding 230 puts for SPY in May, right? And I have been holding them since yesterday, even through the rally. In fact, yesterday at the top, I bought one more because I know that ultimately by May, SPY is going to go down. Now, the good thing about it is I intend to exit those puts today and buy some calls if I get the chance. I haven't made up my mind yet, but that's what I intend to do. If I can see that this rally continues up, as I said, nothing moves up in a straight line. So you see a up and then a down and then a up and then a down and up, and then eventually we're going to touch this 38.2 fib retracement. But because of the fact that people view at those contracts more valued, therefore they start buying those contracts, and that's why your puts did not lose value. Okay, does that make sense? Hopefully I answered that one. How can you tell this is a dead cat bounce versus the market going up? Okay, well, Rahul, the main idea behind the thesis of this being a dead cat bounce V2 and not being a market rally is because the macroeconomic conditions and the economic conditions of the US business environment have not improved. We still see businesses shut down. We still see no consumer spending back in the market. We still see travel that is completely on standstill. And we still see quarantine and lockdowns being issued, as well as death rates increasing and infection rates increasing. Now, this does not signal in any way that the market is improving in condition. And hence, this rally that you see is more like a relief rally, which is what we call a dead cat bounce. Hopefully that answered the question. Hey, Charles, sniff any plugs? Yo, hell yeah, I have sniffed. I actually sniffed multiple plugs today, bro. Free electricity. Okay, that's exactly what happened to me. I don't know why I did that. I answered this question already, so hopefully that kind of answered that question. By the way, if you haven't already subscribed, please hit that subscribe button, hit a like on this, show me some love, yada yada. If you like the content, leave a comment, even your comments like on what you would like to see in the next live stream. I intend to do these every Monday, Wednesday, and Friday now, which hopefully helps you guys a little more. So, quick question. I have May 195 SPY put, 2 of them. I'm down like 45%. Would you recommend cutting those? The loss or holding on for a better exit? I would definitely hold those for a better exit. As I said, we are in a very volatile month. You are definitely going to get an exit for them. Maybe you won't get like a amazing exit, but you might be able to get a break-even exit. However, if you don't get the exit, still hold on to them. What you can do is you wait for SPY to break through to the upside, hit this fib, and then you average down on your position and hold those puts. Your expiry is in May, right? Yeah, it's May 1st. You're good, man. You'll be fine. what economic data is most relevant to you now? Okay, that's a really good question. So right now, as I mentioned on my previous live stream, the most important things that you need to look forward to are signals in liquidity, signals in the overall corporate bond market improving. You have to see the business environment improving. How is the Fed injecting liquidity in the system? Where are they injecting liquidity in the system to assist the smaller players? See, our economy is made out of big players and small players. Now, during a crisis where business slows down, and obviously this hasn't hit a depression level yet because depressions last for a much longer time. But during a correction level like this, where businesses are slowed down and closed down, it's often kind of like a Darwin situation where only the best businesses survive. So you have to look at it from that standpoint and see, if you were a good business, how would you survive? The only way you would survive is if the government bails you out or gives you some money. So the only effective way for the government to do that is what they're doing, which they started much earlier, which is a really good thing, by the way, is to inject liquidity. So you got to watch for liquidity signs and look at also the unemployment rate, and look at also the new issues on bonds. So you have to keep track of those. There are going to be new bonds that are going to be issued at low rates, and you have to keep track on those, because as long as you see the rates of bonds starting to decrease, that means that people are starting to rush into bonds and fund liquidity into the system. If you see the rates of bonds starting to increase, for example, the price of bonds. Okay, so price of bonds and the rate of bonds are inverse. So when the price of bonds go up, the rates come down. And when the bonds are issued on from the treasuries, they're sold on the open market, right? So investors, they rush to buy those bonds, right? So the more people that buy the bonds, the yields come down because there are more people buying those bonds. So the lower the yields, the better the situation for the government, because they can fund that debt at a cheaper price. But however, if you see that the yields on the bonds start increasing, that means no one wants to buy those bonds. Nobody wants to buy government bonds. What does that say about the state of the economy? That's terrible, right? So we want to see the issuance of bond rates stabilize, and that is important, okay? Okay, and then let's see. What do you think stimulus package will affect travel stocks, airline, cruise lines? Would they move up in a short period? Pre-market, they are up and down again. Yeah, you know what? This is a good question as well. I was honestly going to buy Boeing 2021 June calls. They were trading fairly cheaply at about $3,800, maybe about when Boeing was trading at $95. And I was going to actually buy that one, but I kind of missed the opportunity there, and I kind of dropped the ball because I was looking at other things. I do see that travel stocks are going to get a big pump. However, airlines would be my choice. I would stick out of cruise lines for now, just because cruise lines are a very bulky business. They require, first of all, they're ships. They're not airplanes. Ships are huge. They require a lot of, if there's a virus that's spread on a ship, they have to close down for a month to clean that thing. An airplane, on the other hand, is fairly easy to clean up, and it's just the basics of it, right? Airlines have a better margin business than cruise lines. And so I think that stimulus packages will definitely affect travel stocks, and they will move up. However, I don't know, I can't give you a time frame on that. I think that they will move up with the general market going forward. So let's see, next question. So you said May is good for 195. What about 200 puts a little too soon, or still possibly all right? Yeah, I think that 200, oh man, yeah, 4.6 is a bit too soon, bro. I would go further out. 4.6 is a bit too soon. I would go end of April or 4.17, something like that, mid to end instead of early April. That's a little risky there. Is the unemployment data tomorrow priced in already, or we have a retrace period tomorrow? So this is, I think that it's more or less about 60% priced in, but there will be a shock. There will be a shock of the numbers, because I think that what people are predicting is going to be blown out. Like, it's not going to be as what people think it is going to be. I think the unemployment numbers are going to be far higher than what we have projected, simply because there's just so many people who I know that have got laid off, and during this environment, businesses shut down. So I think that we're 60% priced in. In general, why do we look at SPX versus NASDAQ? Okay, so that brings me back to this slide, right? Differences between SPX and NASDAQ. I've done that here. Let's see. I have it here somewhere. SPX and NASDAQ. SPX and NASDAQ. Where is it? Pull it up right here. Here we go. So the reason why we follow S&P and not NASDAQ or Dow, these are the major differences, okay? The Dow is the most oldest and famous index, and it tracks the 30 largest US-based companies, but also the leaders in those index, okay? Which means to say it's a mix from all sectors, but it mostly has market leaders. Some of them are like Coca-Cola, Johnson & Johnson, McDonald's, Boeing. Basically, monopoly companies are mainly in the Dow, okay? And the NASDAQ, it's actually commonly mistaken. People think that the NASDAQ only tracks tech companies, but actually it has a bigger weight of tech companies. That's the reason why they say it's the tech home. But it actually has other companies as well. And it has the most disruptive and innovative companies. And it's also the second biggest exchange by market cap. So it has approximately 10 trillion, and the Dow Jones is about 6.5 trillion. Now the S&P is tracked because it has been broken down into sectors and given weight for each sector. It's also the best average index because it measures the performance of the top 500 large caps in US equities. It actually has 505, but we call it the S&P 500 because it's more or less 500. Okay. Now this is also cap weighted, so it's market cap weighted, and then you have to realize that this is more averaged out than these two, because these would have market leaders and this would have heavy tech. So these two may not be exactly the best to track at all times. However, they do mimic the movement of the overall market. So that's the reason why we use SPX to track the market. Okay. Hello, Fitri. How are you doing? Option swing. Woo. Okay, so thank you for tuning in. And once again, if you are a trader and you are tuning into this live stream, thank you for coming by. I appreciate you turning up for this live stream. Hit that little thumbs up button so I know that you like the stream, and don't forget to subscribe. Follow Option Swing and Everyday Growth Advisor on Instagram, and check out the content that we post. We actually put a lot of stuff out for free because we believe in your growth and we want to help you grow, and we want to make sure that we can succeed together instead as an individual, because we believe in teamwork that makes the dream work. So thank you for tuning in, and I will see you guys on Friday with hopefully more info. Thank you. Bye-bye.